because they're a broker-dealer.
Right.
But they have a funding problem, as I've written for my subscribers, because they have to go out and compete with Ally and American Express and everybody else for brokered deposits. They don't really have a strong core deposit base. And I've always argued that David and the boys should go buy a bank. Go buy Key. They love commercial real estate. Goldman guys love commercial real estate, you know.
But the other guys, the other big guys, 20 seconds left, they're not worried about?
No, the U.S. Bank is the strongest of the top five. You know, they're the littlest money center, but very well run. I don't bother with the others except to buy their preferreds for income.
Listen, so appreciate it. You took me back, and it was so good to reconnect.
I know. We got to do this again, Carol. We can't wait another decade.
Deal. Not another crisis. All right, Chris Whalen, be well. Have a great weekend. Chris is, of course, institutional risk analyst over at Whalen Global Advisors. As I said earlier, worked for the New York Fed, worked for Bear Stearns, worked in up on Capitol Hill, but a great voice for us to check into on certainly this Friday with a lot going on. This is Bloomberg. All right, everybody, let's get a check on world and national news. Off to Nancy Lyons. She's in D.C., our 99.1 newsroom. Hey, Nance, take it away.
Thanks, Carol. President Biden just received several standing ovations as he spoke to Canada's parliament and told members that no two countries are as close as Canada and the U.S.
Americans and Canadians are two people, two countries, in my view, sharing one heart. It's a personal connection. No two nations on earth are bound by such close ties, friendship, family, commerce, and culture.
Biden also referred to a new Gallup poll in which 88% of Americans gave Canada a favorable rating, putting it in the top spot. He also spoke of the two nations' interconnected industries like auto manufacturing and chip production. A U.S. contractor is dead. 5 U.S. troops, along with a second American contractor, were wounded after an Iranian-linked drone attack in northeast Syria. In response, President Biden ordered airstrikes in eastern Syria yesterday against militant sites linked to Iran's Islamic Revolutionary Guards.
These precision strikes were intended to protect and defend U.S. personnel, and the U.S. took proportionate and deliberate action intended to limit the risk of escalation and minimize casualties.
Pentagon Press Secretary Brigadier General Pat Ryder. The New York Police Department is investigating a suspicious envelope filled with an unidentified white powder delivered to the building that houses the Manhattan DA's office. That's the office that's in the midst of a grand jury probe of Donald Trump over a payment to adult film star Stormy Daniels. And there's good news and bad news on a new report on coffee consumption. The New England Journal of Medicine has published a study showing coffee does cause people to move more, with many taking as many as 1,000 more steps a day than those who do not drink caffeine. But it also found coffee lovers do sleep less. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
stories, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We check markets all day long here at Bloomberg. We got a rally underway, and this update brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds to see if your small to medium-sized business qualifies for a payroll tax refund. If your business was impacted by the pandemic, this is your opportunity to take control of your business's future. Learn more at getrefunds.com. Stocks higher across the board. Now let's head right over to the First Word breaking news desk for today's afternoon call. Here he is with the Friday edition, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks in the green after a choppy trading session. The Dow is currently up 112 points, was down 300 as Deutsche Bank spooked the markets on the open. S&Ps are up 20 and NASDAQ gains 26. The U.S. 10-year yield falls to 3.37%. Gold is down 14. Energy trading in the red, and Bitcoin is lower by 1.7%. Of the main 11 S&P sectors, only consumer discretionary and financials were in the red. And leaders to the upside in the Dow, Amgen and Procter & Gamble, while Disney and American Express led to the downside. In other news, Bullard says he's raised his 2023 Fed rate projection to 5.625%, and short sellers stepped up their bets against office owners. Wrapping things up, Microsoft's $69 billion Activision deal got a boost from UK regulators. ATVI was up 6% on the session. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, have a great weekend, Bill. And to hear live breaking news over at your Bloomberg, type Squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just about 17 and a half minutes left in today's trading session. Carol Masser along with Bloomberg's Jess Manton. We are live in our Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. And stocks holding on to their gains of the session. It's not gangbusters, but mind you, everybody, we are well off our lows of the session. And Jess, we've got continuing to see that two-year note well below 4%.
Right, and that is, again, been the key indicator. And clearly also when we're talking about under the hood for the S&P 500, the search for income continues again today when you're looking at the leaders, utilities and real estate. Once again at the top, both of those sectors up more than 2% in the S&P 500.
A telling trade. All right, so let's get to it, and let's get to our drive to the close guest. Dana Dioria is back with us, co-CIO of the Independent Investment Advisor InvestNet PMC, joining us via Zoom from Pennsylvania. Dana, nice to have you back with Jess and myself. How do you see the trade right now?
Thanks for having me. Yeah, it's really interesting to me, what's the sort of dichotomy right now going on in markets, the fact that we're seeing such resilience, and at the same time, banks are really under a lot of pressure. Every new day brings another bank to kind of get the focus and be looked at. And on the one hand, you could say, well, regulators are successfully, calming markets at a higher level. I think it's hard to kind of listen to comments that, hey, the banking sector is resilient, all will be well, when you're talking about a business that kind of relies on confidence, right? And even banks that don't have the troubles that in general were brought on by the rate increases, are going to get looked at sequentially, I think. So interesting dichotomy in markets for sure.
Dana, what I'm really curious about is whether or not most of the pain has already been priced in when we're looking at U.S. equities holding up last week as well as this week.
Yeah, it's a great question. And obviously the market is, or it would appear anyway, that the market is expecting, given fixed income rates, expecting that the Fed will have to pivot. And therefore, the markets will get their Fed put back into place. It's hard to square that with the fact that you have more jobless claims down. I mean, certainly the unemployment rate not ticking up, And we're not seeing, and these things take effect with a lag. So it's not to say that we won't, but we're not seeing yet the kind of movement in these numbers that would cause the Fed to say, hey, mission accomplished, we need to stop. So my thought is that we may well not have another rate increase, particularly as we see how this banking crisis unfolds, but a pivot just, seems hard to expect where we stand today.
We just had Chris Whalen on, institutional risk analyst over at Whalen Global Advisors. He's somebody who understands the banking sector, the financial sector. We talked to him a lot during the 2008 financial crisis. He's an investor, looks for some opportunities within banking. What's interesting is he said the Fed needs to cut rates right now. And he also said it's time for the Fed to just accept that inflation's going to run hot. It's just the way it is, and we'll be okay. Do you agree in terms of the trade? Because right now we're, take out the banking sector, and we were starting to, I feel like, do okay, even though, inflation still ran hot. How do you see that?
I see a pause as being in order. I was on with your colleagues a few days ago before the Fed made its decision. I expected the 25. Sure enough, we got it. I think everybody kind of thought we're probably going to get it. I would say a pause might not have been the worst thing even before then. The problem is that this type of policy, this monetary policy, it affects with a lag, number one. Number two, you're only impacting, or you're most strongly impacting, interest rate sensitive parts of the economy. So you're trying to defeat inflation with, this one sort of, it's a hammer kind of situation, and everything therefore has to become the nail. So I think a pause would absolutely be in order. I know the Fed is concerned about stop and go policy, absolutely concerned about inflation running too hot. We have to consider that inflation may not come out around 2% long term, at least not for the near term. Now, the caveat to that is if we're running at year over year inflation higher than 3%, 4%, et cetera, of course we have to keep tackling that. But sort of waiting for the effects of what's already been done before we continue to raise seems like a good policy option for me.
So Dana, has this trade specifically on Wall Street shifted from, as we know, last year's trade of inflation to now the recession trade?
So we had been there for sure. I think, there was some indications for a long time of peak inflation, and absolutely the market turned its focus to, okay, we're heading now towards the likelihood of recession. If not in 2023, in 2024. Obviously, markets are leading indicators. The impact has not yet hit the job market. That usually takes place, though, significantly after a tightening cycle begins. So the expectation is that we are going to feel the pain of this. Interestingly, again, the interest rate sensitive sectors like banks, financials, you're seeing it happen pretty quick and, not surprising in hindsight, right? Given such abrupt and strong increases over time or over the course of a year. But yes, I think the trade has to shift to recession, and we're absolutely looking at that going forward.
All right. So when do markets reprice for that recession? And then what's your strategy ahead of that, or at this point? And we've got about a minute to go.
So quickly, margins coming in for companies, right? Earnings seasons that increasingly demonstrate the fragility. You're seeing, for example, tech margins coming in, and yet tech is going strong. Mm-hmm. My quick in the 1 minute is I don't view tech as being the defensive sector that we've all converted it to mentally. I think traditional defensive sectors are a better place, in an environment like this. Consumer staples, a counter-cyclical, higher dividends, lower beta. Healthcare, largely counter-cyclical and more attractively priced. Standard, sort of fundamental quality indicators and even low volatility indicators more than tech would be my play.
All right. Really appreciate it. Dana, have a good weekend. Dana Dioria, she's co-chief investment officer over at Investnet, joining us via Zoom from Pennsylvania. Just got about 11 minutes left in today's trading session. Just rolling over, but still just off our best levels of the session. We're up about 0.4% on the S&P, Dow up 0.25%, NASDAQ just up a hair, not quite 0.2%. And as Jess and I have been talking about, you've got that 2-year note below 4%, 3.77 to be exact, 10-year note with a yield of 3.37. This is Bloomberg Radio.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet, 353 on Wall Street. We've got the Dow, the S&P, NASDAQ all higher. Deutsche Bank has become the latest focus of the banking turmoil in Europe. There's ongoing concern about the industry amid a slowing economy sent its shares slumping the most in 3 years and the cost of insuring against default rising. Jan Patrick Barnert is following Deutsche Bank for Bloomberg News.
If you have a bank like Deutsche Bank, who is hugely exposed to corporate lending, and then especially to Germany, which is in turn exposed to the global economy, it's a stock that you're selling more than others if you are repositioning for this hard landing story that we are seeing over the past 2 weeks.
And right now we've got Deutsche Bank shares lower by 3.1%. Bloomberg News has been reporting that Credit Suisse and UBS are among firms under scrutiny in a U.S. probe into whether bankers helped Russian oligarchs evade sanctions. Credit Suisse shares down 1.5%, UBS down by 0.9%. Oracle is cutting jobs at its Cerner digital health records unit, particularly in marketing, as the software giant works to integrate last year's $28.3 billion acquisition. Multiple people with direct knowledge of the matter say workers were informed last week that their positions had been eliminated. Today we've got Oracle shares up, taking part in a tech rally. Oracle shares up now by 0.1%. Oracle now at 87.85. And those are some of the company stories that we are following for you at this hour. I'm Charlie Pellet, and this is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenovec on Bloomberg Radio.
All right, everybody. Carol Master along with Bloomberg's Jess Manton live in our Bloomberg Interactive Broker Studio, streaming on YouTube and Bloomberg Originals. As you know, Tim is on leave. We're just a few minutes away from closing the day of trading as well as wrapping up the trading week. And stocks are just off their highs of the session. And as we've been talking about, that two-year note continuing to stay below 4%. Just having said that, one of the things that you've been writing about and reporting out is the recession trade.
Exactly. So things shifting, like we were just talking about, as far as moving away from trading on inflation to trading on this potential, obviously slowing economic growth. If you look at the terminal, the expectations from economists for to see a mild contraction in the second and the third quarters of this year. But I was talking to Gina Martin Adams over at Bloomberg Intelligence, and this is what's important. It's the length of an economic downturn that really matters for specifically stock investors. So the peak and the depth to the peak to trough real GDP declines isn't historically
so how long,
correlated.
how deep, right?
Exactly. It's how long and how deep. And so shorter recessions have typically led to more rapid rebounds. Now, again, that doesn't necessarily mean that.
But that makes sense.
It does. It doesn't. It makes sense.
It's
and
logical.
and if you look toward the end of this year and then going into early next year, economists thinking that we're still going to see that economic growth there. So it's not to say that, we're definitely going to go into a recession or we haven't already gone through one. But typically, if we do go through a shorter recession, that does bode well for U.S. stock prices.
All right. So that kind of makes sense, right? It's kind of like, all right, let's get the worries out of the way. Let's get through it, especially if it's kind of a quick recession. We've talked about that. If it's kind of a touch and go and pretty shallow recession, you know how investors are. They look ahead, right? And they start to trade certainly on what's to come rather than what was. So that is certainly something to think about as we watch the trade. Having said that, we are expected to hear something from Janet Yellen, the U.S. Treasury Secretary, meeting with Jay Powell and other regulators on the concerns within the banking community, what she could say, how that could shape the tone as we head into the weekend.
Especially when we heard from her right on Wednesday, and then obviously at certain points this week really affecting markets when they were at the same time hearing from Fed Chair Jerome Powell on Wednesday as well. So when I've been speaking with my sources, they feel like there's a lot of confusion and they're hearing different things from Yellen versus Powell. So they want more of a clear message. So maybe we potentially get that from Yellen later this afternoon.
You wonder if they've been on the same page. Certainly this week. It's been a little crazy. Communication services, though, the outstanding group for the week overall in the S&P, up more than 3%. All right, time to head over to our TV colleagues. We're going to wrap up the trading day. Beyond the Bell starts right now.
to the closing bell. Seeing some buying here. Green across the screen, Carol Masser.
Yeah, look at it. Taking another leg up here in the last few minutes, which is pretty remarkable. And you guys, we've talked about it earlier. You know, you look at the regional banks. I mean, they're actually rallying today. They're up about 2.8% in today's trade, Jess.
And that has to make investors feel good when you are seeing those regional banks, as well as some of the more larger lenders holding up well, especially if you're looking just on a weekly basis as far as stocks holding up, not just last week, but this week as well, with those weekly gains were made.
I will note that this rally is coming on some pretty light volume. You look at the S&P 500, volume is about 3% lower than the 20-day average, but that's normal for a Friday. Maybe that's comforting that we don't have very high volume right now.
Yeah, absolutely. The volume has definitely tapered off a little bit here. It'll be interesting to see how much exposure people want going on into the weekend. And we should point out, we are up against what is effectively the end of the quarter here at the end of next week. So a lot of people are going to have to reposition. They're going to be forced to reposition based on their mandates. So there could be some interesting price action going into next week. And then, of course, after that, we have to start talking about, once again, Katie Greifeld, earnings season. I know you're a big fan.
Yeah, let's go.
Yeah, earnings season. It never ends. And, well, here we go. We get the closing bells. Like here in New York, the clapping begins and the cheering begins here. And, well, they actually have some reason to clap and cheer here on this day. A Dow Jones Industrial Average higher by more than 100 points, or about 0.4% here on the day. That's not going to be good enough. Well, I take that back. That's going to be good enough to give it a weekly gain of about 0.9%. The S&P 500 higher by 22 points, or about 0.6%. It's holding on to a weekly gain right now of about 1%. The Nasdaq Composite up about 0.3% on the day, and about 1.5% almost on the week here. The Russell 2000, though, is going to squeak out a gain for the day, up about 0.9%, and it's going to end relatively unchanged for the week.
Yeah, speaking of volatility, check out the volatility index, the VIX. I mean, man, at its highs today was up about 2.6 at 25, above 25. At its lows, down more than 2 points at 22 and change, but actually about 21 and change, forgive me. And finishing the day just down about a point here. So I find the complacency in this market amid kind of the news flow this week is startling.
And I mean, it's been interesting. We've been talking about this weekly rally. You can see that on the industry group as well for the day's action. Utilities, though, up at the top, kind of defensive there. Utilities higher by about 3%. Then you have real estate and household products. And there's more green than red, but if you go down to where the red is, you can see semis at the bottom. Remember, they've been on a tear, and they were the leader yesterday. Not so much today, off by 1.5%. And then you have autos down as well, Carol, off by 0.8%.
Yeah, the stock's still up about 23% so far this year. All right, let's get to some individual gainers. This one, number one in the S&P 500, number one in the NASDAQ 100. We're talking about Activision. You know the story. We've been talking about it throughout the day here. It's up about 6% at the close. UK's Competition and Markets Authority updated its provisional findings in Microsoft's acquisition of Activision after some new evidence showed the transaction will not result in a substantial lessening of competition in console gaming in the UK. Basically, God bless you, I think. I don't know. Basically, UK feeling okay about maybe this deal going forward. So Activision certainly a standout here. Number three in the S&P 500. Number two in the NASDAQ 100 is Intuitive Surgical, maker of the Da Vinci surgical systems. You know this name. William Blair initiating coverage with an outperform rating and is bullish about durable growth at the company. So a pop there. And I had to mention Renew Energy Global, up 22% here at the close. It's a $2.1 billion market cap renewable energy company. It's based in India. Bloomberg reported, citing those in the know, that the Canada Pension Plan Investment Board exploring buying the shares of the power producer that it doesn't already own and taking the NASDAQ-listed firm private. So then that explains totally the rally big time in that name, Jess.
And I'll grab the decliners. So have to start off with what we're seeing with the U.S.-listed ADR for Deutsche Bank. It did finish down a little more than 3%. But again, that did pair a lot of the losses, especially pre-market, when it had been down more than 10%. Obviously, we did see that steep rise in the cost to insure those bondholders against the bank defaulting on its debts, and obviously the concerns about those credit default swaps, but still seeing a big pairing of losses there. And I have to point out JP Morgan, obviously big bank in the U.S., but still down nearly 2%, but not a lot. So just want to point that out for perspective as far as how U.S. banks are holding up. And then, of course, I want to point out what's happening with Enphase Energy. Now, it's posting its worst decline in about a week. It was amongst, if you're looking at the S&P 500 and the NASDAQ 100, one of the worst decliners in that group. But also I wanted to point out one that's not on there, so Scholastic, that's down 22%, worst percentage drop since 2003. And that did post a drop, unfortunately, when it came to its revenue in the latest quarter, and it did cut its guidance for the full year. So really seeing that share pressured as well, Romaine.
Let's take a look at yields here, because this has really been driving the story. We talk about coming off what had been 6 straight weeks where we'd seen yields rise. Now we are officially down for a third straight week. We've basically gone from almost 5% down to 3.7 and change on a 2-year yield. That includes about a 6 basis point drop here on the day. The 10-year yield down about 5 basis points. Your 20-year yield making similar moves here on the day. And I would like to point out that most of the indexes that track the debt market, including sovereign debt as well as corporate debt, actually saw pretty substantial gains on a price basis this week. That even includes high yield as well as some of the sovereign debt and the safer stuff out there here. And that really raises the question here is, what crisis? Are we in a crisis? I forget.
Well, I mean, high yield is its own story, but you think about the bid coming into the long end of the Treasury curve. You think about all the rate cuts that are being priced into the front end. What is going to happen? What do bond traders see happening in this economy where that trade would make sense? It doesn't seem too pretty.
You know, we talked to Chris Whelan, who we talked to him so much during the great financial crisis, understands the banking sector. I mean, he basically says the Fed's got to cut rates now. He also says the Fed needs to let inflation run hot at this point. I mean, the concern is, at this point, who else has the Treasury exposure, right? And if you think about it, that's kind of his take at what needs to happen. I'm curious about what happens when Janet Yellen maybe comes out shortly from now and what she says or does maybe when it comes to the bank sector.
Y'all, if we look ahead toward the end of next week, we are going to get the PCE indicator, obviously the Fed's preferred measure to gauge inflation. We talk about CPI so much, and the gap a bit there still between the Fed's terminal rate and CPI. But if you look at where PCE is and where it's projected, not that too far off now. So it does make you wonder, is, when it comes to what the Fed's watching, is indeed, when we look at PCE, will that be right there where they're looking for it to be at this point?
They still got a long way to go here, and we talk about the impact and the work that has to be done. Is that going to be done through the main measures, the policy levers, if you will, or is it going to be done by kind of what we saw over the last couple of weeks when the market sort of did some of the work for them? I'm not sure they necessarily want that, because, of course, maybe that means it's a little bit more out of their control, but you have a lot of forces now, a lot of deflationary forces, I should say, now working, not necessarily in tandem, but certainly working out there in some capacity.
To the point that what we're seeing in the banking sector, what behaviors could change, what that means for the tightening of financial conditions, hard to quantify. It just introduces another element of uncertainty in trying to map the Fed's path forward. I mean, Jerome Powell himself said it's really impossible to quantify what the impact is. It's at least one 25 basis point hike, but who knows?
Definitely. And Romaine, I know you like to do those weekly pop quizzes when it comes to the biggest gainers and decliners, but do you know which the biggest gainer was this week?
Wasn't it like in the S&P, you mean? Wasn't it like Match or something like that?
So it was Regeneron Pharmaceuticals. So
okay.
It was up close to 10%. It was its best week since September.
Wow.
Good for Regeneron.
Yeah, right.
Good for
Some
Regeneron.
bright spots.
Carol, how are you? You're kind of leaning off camera.
Well, you know,
you look good today, by the way.
Thank you. You know, every once in a while we get it right.
That's your compliment.
I really appreciate it. Thank you. I like the bow tie as well. What's interesting is I hope we're focusing on the right thing, and this is in terms of.
What do you mean the right thing?
That going back to, I'm thinking about this conversation we had with Chris Whelan, that maybe we need to stop worrying about inflation at this point. Maybe the Fed does need to stop raising rates. Maybe it needs to cut rates to maybe ease some of this potential exposure. We still don't know, really, right? All these bank balance sheets potentially on what's supposed to be a safe trade Treasury. I know we have to wrap.
Well, I'm sure the regulators are on top of it.
You really think so?
No.
Yeah, exactly. That's my point. So I'm a little worried that data, inflation data, maybe that's not what we need to be worried about at this point. All right, I'm getting yelled at. And I look so good. Faith, I got to stay here. Romaine, give me a coat.
Look at her. She's just feeling herself now. Look at that. Last time I give her a coat.
It's Friday. All right, guys. Have a great weekend.
Jess, when is the wine segment? Is that coming up?
Not today.
Okay.
We had a bank, we have a bank crisis, or so we hear. Can't do wine. All right. Have a good weekend, guys. That'll do it. Beyond the Bell. We'll catch you same time. Money going round and round. And I got to say, the Bloomberg Big Take today talks about how Fed Chair Jay Powell finds he is stuck between his Volcker and Bernanke moments. The point is, Volcker was a slayer of inflation, Bernanke was the crisis firefighter, and Jerome is kind of having to play both roles at once. It's not an easy place to be in, Jess. We know that.
It's so fascinating because what other time in history when we try to compare this to other points have we come out of a pandemic, massive amounts of monetary and stimulus coming out of it, and then looking at the Fed's tools that they have and the place and the pressure that it's putting him in at this point?
This is why we lean on folks like our own Craig Torres. He follows the Fed, he follows the U.S. economy for us here at Bloomberg News, and right now he joins us from our Washington, D.C. bureau. And, you know, I think about it, Craig, right? I mean, you think about this quote-unquote banking crisis and trying to make sense of it. We don't really have anything to compare it against.
Nothing like this. What's striking to me about this, and I've lived through a lot of crises, is it's not really a credit crisis yet. It's a run on banks. Kind of weird, huh?
Well, and especially like, you know, Jess and I feel like all of us have talked around this table this week in the last couple of weeks, this whole idea that treasuries, we always thought that was kind of the safe place to be, and yet that is at the core of some of the problems and some of the unknowns still, right, in terms of bank exposure.
Yeah, it's an interest rate shock. It's not a bunch of loans going bad. It's an interest rate shock, and banks were badly positioned. And something's going on with deposits. Powell said that in the press conference, where they're just running from banks despite insurance. So this is unusual. I thought I'd seen them all, and I haven't seen anything like this.
What specific tools does the Fed have to try to ease these financial conditions and then also shore up the banks? Is it going to be the typical things we've seen in the past, or are there other things we haven't seen them use?
So earlier you guys and gals were talking about this debate in central banking. It's called the separation principle. So the idea is, like, I have these liquidity tools to deal with banks, and I have monetary policy tools to fight inflation. And that's what Powell tried to do with this interest rate hike. I'm going to let my facility handle bank liquidity, and I'm going to keep fighting inflation. But there are many scholars and even former central bankers who would say that's kind of a false premise. Eventually, you keep raising rates, and you're going to break the banking system. I don't know what the answer is. I think you all are right on your show to target this and to watch it carefully, because let's see if they can sustain the separation. And I think what you're asking is, don't eventually interest rates have to do something to help the financial system? And the punchline, to get to Carol's point, is you can't have monetary policy without a banking system. You can't.
Well, and it speaks to Chris Whalen, who we talked to earlier, this whole idea of that because of the rapid run-up that we've seen in rates in the last year, if you think about where we were just a year ago, that exactly, that's his point, that the Fed's going to have to cut rates in order to ease the situation. And this idea that Jay Powell, and I'm not being critical, I wouldn't want to be in his position, but this idea of thinking, well, this part of the Fed deals with that, and this part, I don't know that it's how you get through this, Craig.
I think you're exactly right. That concept is fragile. Maybe one area where I wouldn't agree is that they need to raise the inflation target. As someone who covers the institution and talks to them pretty much daily, that is, I can't tell you how far off the table that is.
But are they wrong? Craig, as you do reporting, do people think maybe we're in a different environment and that 2% just doesn't make sense anymore?
So Powell admitted, I think it was in the testimony in February, we may be in a different environment. We have sort of dislodged ourselves from this chimerica paradigm we were in of low-cost labor, keeping expenses low. We have a big demographic issue in the United States, which is showing up in labor shortage. We may be, but it's way too early, at least in the Fed's mind, to be having a conversation about changing the inflation target. And it's not a conversation they want to have when they're almost 3 times above it.
How much more challenging is it for the Fed to try to tackle this when we were just talking about the massive amounts, not just on the monetary side, but on the fiscal side for stimulus, because obviously we have the tools to try to combat this, but does it also just take time because of how much money was in the system because of the pandemic?
So this is a great point, Jess, and it was something I was working on before all this hit and took all my time. But one of the most interesting things is there's a paper on the Boston Fed's website by a guy who really understands the data. His name's John Haltewanger. And something happened after the pandemic. We had a huge jump in new business formation. It could be stimulus. It could be we just changed the way we work. It could be because we're demanding different products and services. And it certainly is a big change in our concept of green energy that is sweeping. These new businesses are sweeping, let's say, from south of New York down into Florida. It's basically a mid-Atlantic south boom that's going on. And I was talking to someone just this week. Despite the banking crisis, they say this thing has tailwind and legs. It's going to, whatever this is, this new business momentum we have in the United States, it's gonna stay in place. It's gonna take a lot to bring it down.
So does that make it even more complicated to forecast how this all plays out with the Fed when you have that in the backdrop?
Yes, and I think what Chris and Carol are saying, they can keep fighting this with interest rates, but how much damage to the banking system can you do? Right. I agree with Carol's sense there is a limit here. There is a limit.
All right, so when you think about this week, you think about the Fed decision, you've got a great story out on the Bloomberg, and we've all been talking about, the Fed's discount window. I always love these kind of, I feel like arcane things that we don't talk about until we have to. Right, but it's important that it's there for banks, but what is it telling us in terms of some of the flows that we've seen?
So it's an we can speculate. As a reporter, I want to stay close to the facts. So what's interesting to me is they launched this new facility, which primarily stays around the collateral. By that, we mean banks have to give the Fed something as a guarantee when they get money back. And the collateral on the new facility, the emergency facility, is mainly government type debt, safe stuff. But what we see is a lot more banks going to the discount window, which is shorter term and can accept a much broader range of collateral. Mm-hmm. If you had a warehouse full of kidney beans that you were loaning to as a bank, well, you could post that loan to the discount window.
Right.
So for some reason, this government collateral is not really dispersed around the banking system as widely as maybe we thought.
Hey, listen, I want to mention, and this is so great that you're here with us, Craig, crossing the Bloomberg, the Financial Stability Oversight Council that was chaired by U.S. Treasury Secretary Janet Yellen today, releasing a statement from the meeting. The U.S. banking system remains sound and resilient. The council did discuss efforts to monitor financial developments. Just got about 40 seconds. I don't know. What's your takeaway there?
That's pretty flat, don't you think?
It feels like a form letter. You know what I mean? Like, hey guys, we have a problem. We are monitoring. The system's okay. Yeah. Flat.
Yeah.
All right. Sounds like we're going to be talking about this next week. Craig Torres, we so appreciate you. Thank you so much. Craig Torres is Federal Reserve and U.S. economy reporter at Bloomberg News from our D.C. bureau. Just to rehash, the Financial Stability Oversight Council, we've been talking about it. I've been obsessed with it today. Chaired by the U.S. Treasury Secretary Janet Yellen. It was an unscheduled meeting. Fed Chair Jay Powell was there, other bank regulators, and the statement they released, U.S. banking system remains sound and resilient, and it discussed efforts to monitor financial developments. You're listening and watching Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We check markets all day long here at Bloomberg. The Financial Stability Oversight Council says the American banking system remains sound and resilient. This in a statement after today's previously unscheduled meeting. The FSOC said it discussed efforts to monitor financial developments. Treasury Secretary Janet Yellen convened the heads of top American financial regulators this morning for today's meeting. The Dow, the S&P, and NASDAQ all advanced today. It was also another winning week for the S&P 500 index, up now by 2 in a row. On the week, the S&P was up 1.4%. A reversal in the bank slide that rattled markets earlier today spurred a rebound in stocks amid assurances from authorities about financial stability and growing speculation that central banks will have to stop raising rates to prevent a recession. S&P up 22 points, higher by 0.6%. The Dow today up 132. That was a gain of 0.4%, while NASDAQ was up 36. NASDAQ up today by 0.3%. 10-year yield 3.37%, with a 2-year 3.77%. Spot gold down $16 the ounce to $19.76, a drop there of 0.8%. West Texas Intermediate crude down 1% today, $69.22 a barrel on WTI. Recapping, stocks higher, another winning week. S&P today up by 0.6%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening and watching Bloomberg Business Week on this Friday. Carol Master along with Jess Menton, and I was just bringing up how Bitcoin closed today. Yeah, we're just below 28,000, although we did see it pop above that, like it was, I think, early on Monday for the first time since June. We have also seen, Jess, I feel like, the largest digital coin, Bitcoin, and some crypto stocks come back to life this week a little bit.
We definitely have, because there was a particular point when you were looking at the span over the past couple of weeks where it had surged more than 30%. So now the past couple of days, seeing it come back to reality like you were talking about, still below 30,000, now close to 28,000, but still, it was on a tear despite what was going on with a lot of these banks the past few weeks.
It's kind of interesting, right?
Yeah.
Amid the volatility. All right, so let's get to our weekly crypto segment. We reach out to Thomas Kralow. He is Kralow, an investor, influencer, and trader, founder and CEO of Kralow Enterprises. He joins us via Zoom from Dubai. Thomas, good to have you here on this Friday. Tell us what you make of some of the trade this week when it comes to cryptocurrencies, and Bitcoin in particular, and even some of the equity plays.
Yes, hello everyone. Thank you very much for having me. Very happy to be here. And quite frankly, this has been one of probably best weeks so far in a very long time when it comes to Bitcoin. And that is because of, Bitcoin following global liquidity. And we were saying Japan injecting liquidity, so is China. And US was taking the liquidity out of the system, but now in light of the collapse of the banking system, we're actually seeing it come back. So those of us who are actually into crypto, this is just a fantastic time.
So let's take a step back, because not all of our audience may be familiar with who you are. So tell us about how you came to invest in the crypto space and how long you've been doing it, and talk to us a little bit about the trades that have been of interest or productive for you specifically.
Sure. Well, I've been into crypto space for a couple of years now. I have about 10-year background in retail trading, but then recently I've transitioned into asset management as well and founded my own hedge fund and a venture fund. And one of the best, venture fund is probably not that relevant to the current market conditions, but when it comes to the recent plays, once we actually figured out that the banks are collapsing and that people are going to be losing faith, just like in 2008, in the banking system, and just the only difference that this time they're going to have an alternative, which is Bitcoin. And this has given us an incredible opportunity to go all long on Bitcoin. So far it's played out really well. We actually are still long on.
And many would argue it's still early in the game. We've had 3 banks collapse. We're watching. So I think, and many that we've talked to say it's not like 2008.
I was curious, Thomas, how much money have you actually made in the crypto space, and how specifically have you made that money in crypto? What kind of corners of the market in crypto?
Well, in crypto space, really, there is different ways of making money. Certainly, one of the the biggest income that I've had was by simply building a regular portfolio of the assets I believed in back in 2019 and riding this cyclical wave of crypto.
And how much money did that portfolio make?
Well, in percentage terms, it was 2,000%, but money-wise, sadly, I didn't enter with $1 million, so the profit was just a little north of $1 million. So, but for me, it was still quite substantial, considering that I didn't expect this kind of a return.
And that was definitely in the early phases of Bitcoin. So how has that evolved to these other coins where you think of maybe some of these more riskier ones like Dogecoin, but then also there's Ethereum, but are those coins that you're trading as well?
For sure. Yes, this is something that, as part of my hedge fund strategy, our main objective is to reduce the risks, which is very strange to say about crypto, and also to outperform Bitcoin returns. So certainly there are, when it used to be all about, crap coins, so to speak, right now, actually, there are quite a few projects out there that offer quite incredible utility and purpose behind them, like Ethereum. You don't have to go far to find one that actually has, it's, as a lot of people say, it's ultrasound money, and it's by far more technologically advanced than Bitcoin. But every project, I would say, has its pros and cons. It all just depends on what kind of thing you enjoy most, I suppose.
Last year, when cryptocurrencies came under a ton of pressure, how much money did you lose?
Well, quite frankly, since I'm not just an investor, I am also a trader. So for one, I know how to hedge my risk and how to actually play the market to the downside. That's for one. And number two, my portfolio that I've put together in 2019, I sold it about a couple of weeks before the Chinese FUD, before China actually banned mining, which took Bitcoin down to 30,000 from 60,000. So I didn't really lose that much. I'd say I started buying back into Bitcoin when it was going back down to 40K, 30K. So I started DCAing. So it's not really about losing money. It's more of
I feel like it is, though, isn't it? You don't want to lose money.
Yeah, it's very difficult to time the bottom. Who is trying to time the bottom usually doesn't really enter at all.
So I guess, like, to your point, what's the time horizon you're looking at here, right? Like, are we talking a few, 5 years, 10 years, a couple, like, what is the trade for you? Because when you think about portfolio managers, they obviously have a particular time horizon as
And
well.
what's the top?
Right,
Is there another near-term top? Yeah.
For sure, yes. So when it comes to, for Crollo Capital as an example, our time horizon is a minimum of 3 years. So everything else is just market frequencies that I certainly enjoy as a retail trader for my personal interest and sports interest, so to speak. But for our hedge fund, we don't use any leverage, and we just DCA into the assets we believe in. So usually it's a 3-year time horizon, for sure.
Well, so in the last couple of weeks, how actively have you been trading the crypto space?
For our fund, not very, because the last time we actually bought into Bitcoin was at $17,000. That was the last point when we were actually buying into it. For now, I'm holding my horses, so to speak. I want to see as to how the whole situation with the banks is going to play out, and subsequently also regulation. So for now, we are happy with our positions. But when it comes to my personal retail trading, then I certainly am enjoying my long trade, but I'm not looking forward to flipping it short just as of yet, despite the actual Binance suspending withdrawals right now, which is still a big fear. But for now, I'm still long for my personal retail trading side of things.
What specific level for Bitcoin are you watching for a threshold to see when it's reached its near-term inflection point versus stocks?
Yeah, I think that's the most important point. Well, we have to consider also all the regular indicators, which actually point to the fact that Bitcoin has decoupled from S&P 500 and NASDAQ, and really any high-risk asset out there, and is outperforming those assets for obvious reasons, because of the banking collapse and stuff. But I think that the most important point in the price for Bitcoin for us to actually, kind of start celebrating is $30,000, and we are fighting fiercely for it right now. We're close to it. So I say once we clear 30K with large amount of volume, that would be something to consider as true reversal, in my opinion.
So we have seen Bitcoin outperform not just stocks, but also when you're looking at the commodity space. What specific risks are you looking at to see if it could upend that particular trade in the near term?
Right. So I would say that there are a few systemic risks when it comes to Bitcoin. Certainly with the current, just the narrative itself, was also the narrative risk, which actually is been brought down to close to zero right now because of the, again, fall of the banks. But one of the biggest risks currently as we stand is, number one, regulatory. So that could translate into, for example, ban of Binance and subsequent potential crash of Binance, which would just be a huge systemic risk. But besides this, the most biggest one, I think, is Tether. So if Tether, the issuer of USDT, were to be receiving a Wells notice and subsequently cease to exist at some point, this could definitely set us back 5 or even 10 years. Something as crazy as that. So these are two biggest things.
All right, gonna leave it there. Hey, Thomas, thank you. Thomas Crollo, he's Chief Executive Officer of Crollo Enterprises, joining us via Zoom from Dubai. And I just wanted to take a look in light of those headlines from the Financial Stability Board at the Treasury. U.S. banking system remains sound and resilient, and it also discussed efforts to monitor financial developments. This, of course, was the meeting of the Financial Stability Oversight Council being chaired by the U.S. Treasury Secretary. And Jess, I'm just looking at the SPDR S&P Regional Banking Index. It's pretty much flat in the aftermarket here. I'm no surprise. And if I look at the KBW Bank Index, just up, it looks like a little bit up, about 0.4%.
So you're not seeing markets move too much way up or down on these headlines so far.
I think what Craig Torres said to us, it felt a little flat, but nonetheless, we'll continue to track this. All right, right now, though, we do want to get an update on world and national news. We got to head back to D.C., 99.1 Newsroom, and Nancy Lyons. Hey, Nance.
Thanks, Carol. President Biden is working to shore up the relationship with Canada, speaking to Parliament earlier in the afternoon.
Today I say to you, and to all the people of Canada, that you will always, always be able to count on the United States of America.
Biden announced the two countries have reached a deal on immigration, with Canada accepting 15,000 asylum seekers from the Americas. A federal judge in Washington says former President Donald Trump's former chief of staff, Mark Meadows, as well as a large group of other former top White House and Trump administration officials, will have to testify regarding the January 6th attack on the U.S. Capitol. District Judge Beryl Howell is rejecting Trump's claim of executive privilege that would have kept them from testifying. Many schools across the country are seeing a rise in problems in class, and parents and teachers think they may know why.
They say it could be linked to an ongoing shortage of Adderall and other medications for ADHD. The federal government first reported the shortage in January thanks to supply chain issues and rising demand. Dr. George Giuliani with the National Association of Special Education Teachers tells the Wall Street Journal students who've gone off their meds can have trouble concentrating or completing schoolwork. He says behavioral changes can be severe, and a number of schools have reported increases in fights, suspensions, and students having trouble sleeping. In Washington, I'm Nathan Hager, Bloomberg Radio.
The House narrowly passed legislation to give parents more control over what's taught in public schools. The bill would require schools to publish course studies and a list of books kept in libraries. House Speaker Kevin McCarthy calls it a significant accomplishment.
This bill will go on to the Senate. We hope they'll be able to take it up. But this is a win and a change for America.
Senate Majority Leader Chuck Schumer says the bill faces a dead end in his chamber. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We check markets all day long at Bloomberg. Banks remain in focus, and in the past few minutes or so, top regulators said that while some banks are coming under stress, the overall financial system is still sound. Treasury Secretary Janet Yellen convened the Financial Stability Oversight Council this morning. The panel heard a presentation from the staff of the Federal Reserve Bank of New York on the latest market developments. A reversal in the bank slide that rattled markets earlier today spurred a rebound in stocks. The Dow, the S&P, and NASDAQ all advancing. A weekly gain, in fact, for the S&P 500 index, 2 in a row. On the week, the S&P was up 1.4%. Today, the S&P climbed 22 points, up 0.6%. The Dow up 132, up 0.4. NASDAQ up 36, a gain of 0.3%. 10-year yield 3.36%, with the 2-year 3.76%. Gold down $15 the ounce to $19.78, down 0.8%. West Texas Intermediate crude down 1%, $69.27 a barrel. Now, what about talk of a Fed pivot after this week's 25 basis point increase? Dana Diori is the co-CIO of Investnet PMC, and she was our guest right here on Bloomberg Business Week.
We're not seeing yet the kind of movement in these numbers that would cause the Fed to say, hey, mission accomplished, we need to stop. So my thought is that we may well not have another rate increase, particularly as we see how this banking crisis unfolds. But a pivot just, seems hard to expect where we stand today.
Microsoft's chances of winning antitrust approval for its $69 billion takeover of Activision Blizzard got a boost after UK regulators narrowed the scope of their probe to focus solely on cloud gaming. Microsoft shares up 1% today. Activision Blizzard up 5.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening and watching Bloomberg Business Week on this Friday. Carol Master, along with Jess Menton, live in our Bloomberg Interactive Broker Studio, streaming on YouTube and, of course, on our Bloomberg Original streaming service. So as we talk about the banking situation and the market volatility, we continue to keep an eye on commercial real estate of all types for signs of cracks amid the worries over banks. And with that in mind, Jess, this next story definitely popped up on our radar. It's among our most read on the Bloomberg today. It's about how another shakeout is coming for shopping malls. So with her Bloomberg Opinion column, with us is Bloomberg Opinion retail columnist Leticia Miranda. She is with us in our Bloomberg Interactive Broker Studio. So great to have you here with Jess and myself. We are all kind of obsessed with real estate generally and just trying to figure out post-pandemic as we see office buildings and the like, especially in major cities like New York still vacant. What happens? The other thing is we see a lot of retail space that's open. Malls, I feel like it's been a troubled sector for a while, even pre-pandemic. What is it that's popping up on your radar?
Yeah, so it has been very troubled, though malls haven't been completely dying, and they actually got quite a lift right when people were coming back to the office and getting back out into shopping and going to restaurants again. So there was a brief time last year when it looked pretty bright.
It was like a fun thing to do after the pandemic, right?
Totally. Yeah. And I think a lot of people were, really excited to get back to their old routines. And a lot of us grew up going to malls, which was a lot of fun being able to do that again.
I'm from Jersey. I know all about malls. But anyway, go ahead.
Texas. That's right. So, but yes, that at the same time, though, that people were going back to malls, there was also all of this other stuff happening in the economy that made it really hard for lending to happen. And malls in particular have been at the losing end of that game. And there was a short window when malls could, kind of renegotiate and refinance under lower interest rates. Maybe you all know this, but malls live and die on debt. And that's the way that they invest in their businesses, and they're able to upgrade and make all those important changes to malls to make them brighter, bigger, have
and it's all spaces. A lot more expensive now, right?
Exactly. So it's been a tough year right now. It seems the window is kind of closing on malls to be able to get in and get cheap debt or cheaper debt to be able to do what they need to do. And it was kind of like this bright spot that's now quickly dimmed. So we'll see what happens in the next year. But I think that all of the focus on office is kind of taking away some of the focus on retail and malls in particular. But at the same time, I think, this was long overdue anyway. That's my brutal opinion.
So as far as what has gone wrong, especially in the last year, it's been those lending issues specifically.
Yeah, so yes, so consumer spending has been slowing down, interest rates have been going up, occupancy at malls is better, but it's still at a lot of these like mid-tier malls, like Class C, Class B malls, occupancy has not really come back up. So all of that does not look great for lenders who are increasingly worried about the economy and where things are going. So
one other thing I was curious about, because you break down some stats in your story, talk to us about how loan delinquencies specifically are expected to see the highest rates in retail.
Yeah, so it's for all of those reasons. Even just the last retail sales report that we had this month, retail sales are falling now that the Federal Reserve's campaign to decrease inflation to 2% is having some impact on spending. So that's not a great sign for malls that depend on, sales per square foot. And it also isn't a good sign for a lot of these, again, mid-tier malls that have, stores like Gap or Victoria's Secret that are also struggling with getting people in the door and getting people to buy. And then overall, there's been this move to e-commerce, and that's been happening for a very long time. But of course, these credit issues are kind of compounding these longer term issues that we're facing malls.
Well, and the line that you think about, Jess, in the story, Fitch Ratings estimating in November that the highest rate of CMBS loan delinquencies will be in retail, climbing to as much as 11.3% by the end of this year from 5.7% in October. That's a big kick higher.
Yes, yeah. And they anticipate it'll be mostly those B, C malls.
As you say, not everything's gloom and doom. So tell us about those that seem to be doing okay.
Yeah, so definitely the Class A malls. So, Westfield is considered a very strong mall company. Macerich has put in a lot of work into its portfolio the last 10 years to upgrade a lot of its malls and let go of some of its underperforming malls. But they were kind of impressive in particular to me. Because they spent the last couple months, which I feel like just was like right before deadline to kind of refinance under better interest rates. They spent, I think, like a couple $1 million on getting a rate cap for one of their very prized malls, and to try to extend the loan on some of these other prized kind of properties that they have. So at least to me, it seemed like they really saw the writing on the wall and were like, we don't have much time to kind of get this together, and really hustled. But there's other malls that aren't in that position to do that and didn't spend that time doing that for whatever reason.
Can I ask you about, I have to, as someone from New Jersey, the American Dream Mall, which has gone through various iterations, if you will.
Yeah.
Just quickly, your thoughts on that one.
Oof.
Or what you're hearing. I mean, I looked at CBL. I think they're up about 5% year to date, but, it'll be interesting to see what happens with this one.
Yeah, I can't say too much about American Dream Mall. I don't know that too much. I know that a lot of their financing is a little complicated.
Right, it is.
But so it seems like sort of a messy financial situation. At the same time, they're losing traffic. And there's also, it sounds like, competing narratives about whether or not they were open and are due to pay back some of these payments. So
right, and in the story, right, that they're being sued by bondholders. So there's a lot. It's just Google it, guys, because it is complicated, and I understand because there's so much going on. We got to run, but Leticia, thank you so much. Really appreciate it. Leticia
thank you.
Miranda of our Bloomberg Opinion team. She covers the retail area. You're listening and watching Bloomberg Business Week, and Bloomberg Business Week, it is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds to see if your small to medium-sized business qualifies for a payroll tax refund. If your business was impacted by the pandemic, you can find out more. Just head
to getrefunds.com. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Bank of America is trimming its wealth management, banking, and lending group as higher rates continue to crimp business on Wall Street, forcing banks to make broader cuts. Sources say fewer than 200 staffers were offered different roles in other parts of the company, while a handful, including some loan officers, were let go. Bank of America shares up today by 0.6%. Ford plans to make driver assistance features central to the next electric F-Series pickup, so much that you might be able to take a snooze at 60 miles an hour. Bloomberg Television caught up with CEO Jim Farley, who spoke with us about the company's newest plant that's under construction in Stanton, Tennessee.
It'll be fully software updatable, for example, and also we hope to land our semi-autonomous feature, so on the highway in a sunny day you should be able to go to sleep in your truck or make a call or do whatever you want to do in your truck while it drives for you. So it's going to be Bill Ford tough, but it'll be completely digital. It's a really breakthrough product.
Transportation officials have warned repeatedly that no commercially available vehicle today can drive itself, even as companies such as Tesla market boundary-pushing driver assistance features. Today, Ford shares are up 0.8%. Tesla shares today down 0.9% to 109.41. And those are some of the company stories that we're following for you at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, more Business Week to come in just a moment. First up, though, let's get back to world and national news. An update for you with Nancy Lyons in our 99.1 newsroom in Washington, D.C. Hi, Nance.
Thanks, Carol. President Biden is still in Canada, an official guest of Prime Minister Justin Trudeau. He spoke to Parliament today and received several standing ovations. Bloomberg Irv Chapman with details.
The two leaders spoke of their comparable agendas to mitigate climate change.
There will continue to be vans delivering food to grocery stores in California and trucks delivering medical supplies to hospitals in Pennsylvania that roll on tires made in Nova Scotia.
And I believe we have an incredible opportunity to work together so Canada and the United States can source and supply here in North America everything we need for reliable and resilient supply chains.
Prime Minister Trudeau joined President Biden in promising support for Ukraine as long as it takes to repel the Russian invasion. In Washington, Irv Chapman, Bloomberg Radio.
There does appear to be some momentum toward addressing the nation's debt ceiling. Bloomberg's Anne-Marie Hordern with the update.
We heard from the Republican budget chair, and they said that they are ready to go to the White House with what is called a debt sheet, not a cheat sheet, a debt limit sheet. I'm basically telling the Biden administration from Speaker McCarthy's office and the House Republicans, these are the demands we have in order to sign up to raise the debt ceiling.
Hordern says it could take several more weeks before Republicans actually have a budget to share with the White House, which is what the president says he wants to see before starting any negotiations. Former White House Chief of Staff Mark Meadows and other top aides have reportedly been ordered to testify to the federal grand jury investigating former President Trump's efforts to overturn the 2020 election. Multiple sources say a federal judge has again rejected Trump's claims of executive privilege. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Carol and Jess.
All right, Nance, thank you so much. Bloomberg Business Week brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. Thousands of small businesses benefited from a payroll tax refund and beat the odds of shutting down their organizations. This refund is not alone and could help your business weather rising inflation and supply chain issues. To learn more, just head to getrefunds.com. Well, March, as you know, is Women's History Month, and every day this month we are celebrating significant moments in women's history. So let's get your installment for this Friday, March 24th. For that, here's Bloomberg's Lisa Mateo.
On this day in women's history in 1996, Shannon Lucid becomes the first female U.S. astronaut to live aboard a space station. Cheers from a crowd of her fellow NASA co-workers as she returned to her hometown of Houston, Texas, after spending 188 days on the Russian space station Mir. Lucid first flew aboard the space shuttle in 1985, followed by 3 more missions. In all, she spent 223 days in space, then a record for most time spent by a woman. Lucid received bachelor's, master's, and doctorate degrees from the University of Oklahoma. After working as a laboratory technician and research